These are my hockey skates, which I've used for almost 20 years. I've worn them through dozens of wheels, and they've held up incredibly well. And of course, you know that they're made by... We're gonna dive into a stock that's made waves lately, and not in the good way. We're talking about a giant in the athletic wear industry that's suddenly looking wobbly because revenues are down, guidance has been slashed, and some are even saying it's the beginning of the end for this long-time market leader. But is it time to count them out? We're going to take a closer look. My name is Russ, and this channel is where I share my passion for passive income. I am not a professional, and I hope you are not taking any financial advice from me. So picture this, a company that's been at the top of its game for decades. They've weathered countless challenges, seen competitors come and go, and have consistently delivered innovative products that consumers love. But lately, things have been tough. Now, their CEO recently dropped some not so great news about a bit of a sluggish growth streak and reduced expectations for the year to come. And the stock price has taken a nosedive, hitting lows that we haven't seen since the COVID crash in March of 2020. Now, you might think it's time to run for the hills, but hold on a second. For long-term investors like myself, this situation spells opportunity because sometimes the stock price doesn't reflect the actual value of the company. I want to talk about their competition because there's some new players in town, particularly in the running shoe market. And while they're showing impressive growth, this is a story that we have all heard before, haven't we? Remember when Under Armour was supposed to be the next big thing? Yeah, how'd that work out? So I think that these newcomers are doing great in their niche, but they have a ways to go before they really start to challenge all athletic fields and lifestyle spaces. Now, the company we're talking about isn't just about shoes. They're the global leader in athletic apparel, accessories, and footwear, leaving even their closest competitors in the dust. So dethroning this king? I think that's a tall order. So by now you've probably guessed that we're talking about Nike. The swoosh here might be bent, but it's far from broken. And here's why I'm still bullish on Nike for the long haul. SimplySafeDividends.com gives Nike a dividend safety score of 99, very safe. So if you're in it just for the dividend, chances are that thing's gonna be just fine. And as of this recording, it's a newer position for us, and I'm currently up to 29 shares with an average cost of $75.98 per share, and we're down about 3.4%. And as of July 3rd, 2024, Simply Safe Dividends did reaffirm that dividend safety score of 99. Nike has paid uninterrupted dividends for 40 years, and they've grown them for 22 consecutive years, a 15% 20-year CAGR. It will remain to be seen if they can keep that up, but they raised that dividend 8.8% in November of 2023. Now, they'll likely raise their dividend again around turkey time of 2024, but currently they are paying $1.48 per share annually. But that dividend yield is 92% above the 5-year average of 1.05%. The forward price to earnings ratio is 23.3, which is about as low as it's been in the last 5 years. And they are just a hair above their 52-week low as of this recording. But this is a very well-run business, very low free cash flow payout ratio. We had that one aberration in 2020, but all things set aside, that was a haywire black swan year. So they are well suited to keep paying that dividend and growing it for many years to come. And we do see that their free cash flow per share is expected to take a little bit of a hit, but you know, this is one of the things to expect with a consumer discretionary business, meaning that if people just don't have any extra money laying around, they're probably not going to forego food or gas in their car to buy a new pair of dunk lows. 0% sales growth as of last. You know, it's been a bit of an ugly run for them lately, but their total sales still up and to the right over the long term. Probably going to flatten out a little bit here. And their shares outstanding, they are still buying back shares down to 1.53 billion. These margins are beautiful. You want to see a return on invested capital of about 15% because that means they're going to be able to bring in more money then the cost of capital, return on equity. Hey, 20% is fantastic. Nike at 40%. Free cash flow margin 12%. That means 12 cents out of every dollar coming in the door is turning into free cash flow. And with the free cash flow, you can do a few things like pay the dividend, buy back shares, carry it as cash on the balance sheet, or pay down debt. And their net debt to capital is basically non-existent. They have more cash on hand than they do long-term debt, and their interest coverage ratio is 22.25. If you don't know what this means, it's a very important metric, and this tells us that Nike currently has $22.25 of operating income to cover every $1 of interest expense on their debt. So you always want to know, if a business can't pay the interest on their debt, it's not going to be pretty, and they are going to be facing bankruptcy. Nike is in no such danger. They've got a beautiful balance sheet. Now, this is on finchat.io, but I want to show you this number right here, ROCE, which is return on capital employed, which shows how well a company uses its money to make a profit. And Nike currently has an ROCE of 23.01, which means that for every $100 that Nike invests in its business, it makes about $23.01 of profit, which is a very, very good number. You love to see something over 20. And then for a quick reference on an intrinsic value, alphaspread.com gives Nike an intrinsic value on the base case of $70.94. So as of this recording, intrinsic value, remember, is not a number to do to two decimal places, even though you see it. It's a range. So I would say that Nike is about fairly valued. And check this out, interbrand.com recently ranked Nike as the 9th most valuable global brand for 2023. You know that I say every company is a living, breathing entity, and any living, breathing entity's first order of business is going to be survival. So I do not think that Nike's going to just sit around, rest on their laurels, and let the competition eat their lunch. So they've got a pretty good innovation pipeline going on, and these are some of the things that management talked about in their recent earnings call, is that in basketball, they've got the GT Cut, the new Kobe gear, the Sabrina 1, an Asia Wilson signature franchise. Oh, and they just signed Caitlin Clark to a huge deal, so they've still got that star power. And for you fitness enthusiasts, there are the statement leggings like Universa, Zenvi, and Go. You got Motiva and the Free Metcon, which is Nike's #1 women's fitness shoe. And of course, for all you runners, they've got you covered with the updates to fan favorites like the Pegasus with the Pegasus 41, Vomero, and Invincible. And you can't forget about the lifestyle brand Air Max DN, which just dropped, and retro running shoes like the classic Cortez and Killshot. Plus, they're going to be expanding their affordable options with new footwear under $100. And Nike is also geared up for major events like the Eurochamps 24 and the Paris Olympics, and these are huge stages for them to showcase their latest and greatest. I mean, look, I get it. Nike's going through a really rough patch right now, but in my short experience, it really is incredible how quickly a great earnings report can turn things around. I mean, one good quarter and we could see this stock shoot past $85 faster than you can say just do it. Now, we don't know exactly when that'll happen, but I think it's just a matter of time. But you have to remember that the stock market generally looks 6 months to a year out into the future, but I'm looking 6 to 10 years into the future. So here's my bottom line. I think that footwear is going to stay pretty much the same, and Nike is a brand that is going to remain relevant and dominant for many years to come. I mean, they've definitely got the deep pocket resources, they've got the brand power, and they're innovating, which they've historically been successful with when they put the full gusto of Nike behind the innovation. So I think they're going to weather this storm, and they just brought back retired executive Tom Petty to help repair the distribution channels because the stock was free falling. So for long-term singing investors like me, I think this dip is a really great chance to accumulate shares at a great price, and I plan to add to my position in the 60s and 70s and then just sit tight. Of course, I'm going to keep my eye on the business performance in the coming quarters and years ahead, and if something were to fundamentally change with my thesis for investing, then I'll reevaluate the position. But for now, I'm lacing up my Nike skates and I'm getting ready for the long skate. And remember, investing is a marathon and not a sprint, so stay patient, stay informed, my friends, and do your research before making any investment decisions. And if you're new to this channel and dividend investing, in this floating little box next to my head, I talk about 5 beginner dividend investing mistakes that beginners should avoid if you're a beginner. So if you want to see what that's all about, hey, in that floating little box right next to my head, click it and I will tell you all about them there.